All right. We are live now. Today is January 25th of 2023. It is 11 a.m. and we now have live rates for today. So we will go into our regular scheduled program here in a minute. We'll give the streaming a second to kick in. That way we're up on all platforms. And then we'll get into the regular scheduled show. Welcome everyone. Looks like we're now live on a couple more platforms. We got some more viewers. Thank you for joining us. We will get started here in a minute. Today is January 25th, just after 11 a.m. So we have new rates live for today. And we'll get into our program here in a second. Give everybody a chance to tune in. And we'll get started. All right. All right, looks like we are live now. Let me go ahead and officially get started. Welcome everyone. My name is Nick Hiersche. I am the president and founder of the Mortgage Calculator. We are a lender that specializes in alternative income documentation loans, as well as your conventional VA, USDA, FHA, all these standard stuff. But what we like to do every morning here is host this show, go over the live rates for the day. Today is January 25th, 2023. It's 11 a.m. here on the East Coast, so we now have live rates on all of our programs. And I'll be joined today by our sales manager, Jose Gonzalez, with 27 years experience in the industry, who'll go over a deep dive here on our featured product, which I'll introduce in a second. And we have Kyle Hiersche, our COO, who will go over how to connect with our team here once we go through the rates. So today's topic is going to be the BRRRR strategy. This really entails a couple different pieces. So Jose will have a few minutes here at the end to go over the details of that. And really what it means is typically a fix and flip loan, which is the buy, the B, and then renovate, obviously, with the fix and flip loan, and then rent the property, get it rented, and then refinance. So you refinance into the permanent loan and obviously hope to cash out some of those proceeds from the increase in value from the renovation. And then, of course, the last R is for repeat. So this strategy is what a lot of investors, particularly flippers, but these are fix and holds, right? Instead of fix and flip and sell, typically these are customers that are going to fix it, hold it, refinance the equity out of that to then do it again and again and again. This obviously builds wealth and property portfolio very quickly. So it's a very cool option, very popular in the the blogs and stuff like Bigger Pockets. A lot of the investor groups are really focused on this strategy. So definitely something we get a request for every single day here at the Mortgage Calculator. And obviously a lot of people are specific about the fix and flip loan, but a lot of people are requesting how do they complete the whole entire project? How do they plan their fix and flip, as well as their permanent financing takeout if they're going to actually fix and hold the property in order to, cash out the equity there to do it all over again. So BRRRR, buy, renovate, rent, refinance, repeat. That is going to be our topic here for today. And once we go through the live rates on the standard programs, I'll have Jose pull up the scenario for this specific strategy that we have here for investors. And he'll actually pull up the purchase loan, the fix and flip, which we went over on Monday this week. We went over some examples there. So he'll go over that real quick. And then obviously give a bunch of options for the permanent financing, the takeout, the cash out, in order to give a couple different scenarios. Obviously depends on how long the project takes. So some very cool options here that we'll go over. But let me go ahead and get started with our regular program and check out the rates for this morning. So let me pull up my rate tool. Give me 1 second here. And let me go ahead and share it. There we go. So this is our price quoting engine. So this is for our mortgage professionals. We have over 300 loan officers, and we're licensed in 17 different states for primary home purchases. And for our business purpose loans for investors, we actually can do those in pretty much every state. So a lot of different options here. Please get with our team members if you want a full quote with a full loan estimate with all the detailed costs. This pricing engine is for our mortgage professional team to check out the pricing and get some quick indications. So please get with our team if you want the full breakdown. But let's go ahead and run through what the pricing is this morning on some standard scenarios. So what we always do is we'll pull up a typical scenario, 400,000 loan amount, 80 LTV. That means 80% loan, 20% down payment. Our desired price is going to be 99. That means we're going to shoot for the best rate with one discount point in buy down. Typically, our customers in this rate environment are asking to buy down the rate a little bit to try to make it better, whether that's a huge temporary buy down or a permanent buy down like this request. It varies, but we always typically shoot for a little bit of buy down. Maybe you can get that financed through a seller concession or some other things that are happening very often in this type of market. First, we're going to go through our conforming conventional options. Then we'll go through an FHA option, which is typically option number 2 for most buyers. Then we'll go through our expanded guidelines, aka our non-QM alternative income documentation. That's where we specialize here at the Mortgage Calculator. And then if our customers do qualify for VA or USDA, please let us know. We can quote those in just a couple minutes. But to qualify for VA, you must be eligible and must have served and have a certificate of eligibility. If you do, we appreciate you, and we'll quote that up real quick. For USDA, those are only for rural properties. So if you're looking in a rural area, we can quote that really quickly as well, but not applicable to everybody. So we'll focus on these top 3 options today and go through some basic scenarios. So we're going to do conforming, purchase, 30-year fixed, all the kind of standard stuff most people consider a standard mortgage. Primary, single family, 1 unit. We're going to use Florida, Miami-Dade. That's where our office is based. And for all of our estimates today, we will use a estimated FICO of 760 and an estimated debt to income ratio of 40 in order to just get some general pricing indications for this morning. So let's check out what rate options we have. Like I say every morning, this is actually live, so I have to pass a security check. And here we go. So these Home Ready and Home Possible are specialty programs for borrowers that do qualify in an area median income or a census tract. So not applicable to everybody. So let's cruise down to the first standard option. And right here, first standard option I can see, conforming 30-year fixed. Our rate today is 6%. Yesterday on the show, it was 6,125 for the same cost. So you see the rates change every day. They go a little up, a little down. And today they're a little bit down from yesterday. So that's why we love to host the show. So 6% rate for just under 1 discount point in cost. And we have a few other options as well. Obviously, you see the list is really large here. Tons of different programs with little specific niches. But please get with our team if you want to navigate through that. But it's great to do the show every day and see the rates going down from yesterday. Everybody loves to see that. Now, let's go back to the pricer. And let's check out another example for a borrower who may not qualify for conventional. Typically goes to FHA as the next option. So as loan officers, when we select FHA, that allows us a little bit of leeway with the debt to income and a few other lenient factors that allows borrowers to typically qualify for FHA easier. So this is typically the second option. Oops, I did 81 here. So let's ask for PMI. There we go. 80% LTV, same thing as before. Everything else is going to stay the same. And let's check out what our FHA purchase options are. So it looks about the same. So it looks like FHA didn't move. I believe this is the same option that showed up yesterday. So 5.5 rate for just under 1 discount point. So FHA didn't move as much as the conventional, but always a great option. Remember to keep in mind, FHA does have typically a additional cost there for the monthly mortgage insurance and the upfront mortgage insurance premium. So the APR is something to look at when you're looking at FHA because it does have typically additional costs on top of a standard conforming loan. So great options there for borrowers who may not qualify for a conforming product. Now this is where we love to specialize at the Mortgage Calculator. Let me pull this back up to 80. And instead of going with FHA, if a borrower doesn't qualify for FHA, many banks or lenders may not have the non-QM options that we have. So we love to have non-QM available because Typically, you're stuck here at this point if a customer doesn't quite qualify for FHA. But now we can click expanded guidelines, and we have thousands of programs to use for our customers under these expanded guidelines that go beyond the scope of conventional and FHA. So tons of different options here, and you'll see everything else will stay the same. But now we have a new pop-up here called income documentation. So these non-QM programs allow us to use alternative income. So 1 year of alternative income or 2 years. We also have asset-related alternative income. We can use business bank statements, most popular 12, 24 months. Investor DSCR, most popular program by far, but only for investment properties. We'll get into that in a second. And then our most popular program are our personal bank statements, a 12 month or a 24 months. So for our example here this morning, we're going to do our most popular program, the 12-month bank statement. This is going to be for a self-employed borrower who may not qualify for FHA or conventional full doc, because a lot of times conventional borrowers, self-employed borrowers, when we do the conventional analysis, don't quite meet the income requirements. However, with the non-QM, we can use, instead of their full documentation in their tax returns, we can use 12 months of personal bank statements to determine that their cash flow situation will work to determine a debt to income ratio. So in this case, we've used 12 personal bank statements to determine a debt to income ratio of 40 for this borrower in order to qualify them with bank statements. So let's check out the options we have here for a borrower who would not otherwise qualify. So the rates are obviously going to be a little higher on our non-QM programs, but again, this is for someone who would not otherwise qualify to get their dream home, can now purchase the home of their dreams. So we have an option here, 7125 for 1 discount point, 7875 for under 1 discount point here for alt doc. There are hundreds of programs here, as you see as we scroll down, with various rate and cost combinations. So we have some great options. Some of these options are for borrowers that maybe have credit events, such as a recent foreclosure or bankruptcy. Non-QM does allow that. So you'll see some of those other alternative programs towards the higher end of the rate stack end up having special qualifications where we can expand the guidelines even further. So we love all these programs. Please get with our team members. They can navigate which one of these hundreds of options work best for your case. But again, some great options, just a little bit higher than conventional here, but making people's dreams come true. So we love the non-QM options. Let me go back to the pricer, and the last 2 scenarios we'll run for the live rate show here portion. We'll do for investment properties. So for an investment property, we can only compare conforming with our expanded options. So if you're working with a bank or a lender that doesn't have non-QM, their only option is conforming. FHA, VA, USDA does not work for investment properties. So conforming is typically the only option that lenders used to have. Now we have thousands more beyond this, but let's check out our conforming rates for investment property. Everything else will stay the same here. And we'll see that the rates for conventional investment are going to be much higher than the primary. You'll see here rates are in the 6s, which is great, but you'll see here a large amount of discount points. That's because there are additional costs attributed to investment properties under the conventional programs. That's not really our choice. That's the GSEs, the government-sponsored entities that are insuring these programs, are adding additional costs to investment properties. So many of our investors now obviously love low rates, but with these high discount points, they're obviously asking for other options. So typically, typical bank or lender may not have any other options if they don't have non-QM programs. However, here at the Mortgage Calculator, we have thousands of other options beyond what you see here on the screen. So these are great, but our investors typically want lower discount points, and they're willing to go up in rate in order to get those lower discount points, which at this time conventional just doesn't allow, unfortunately. So if we pull up our quick pricer, pull up our last example here, 80 LTV, 20% down, pull up our expanded guideline options, pull up investment. Now we have our income verification. We can obviously do a ton of different options, but our most popular by far going to be our DSCR options. That is because there is no income verification, no employment verification, or no income verification for the borrower. We're simply going to use the estimated rent from the property in order to offset the PITIA of the loan. So no income documentation under this, which is an amazing product for our investors to quickly buy and refinance properties at scale. When we do a non-QM investment property, non-owner occupied, we're typically always going to add a prepayment. Obviously, there's options to have no prepayment. So if the borrower wants to have no prepayment, that's fine. It just costs a little more. 3 years is the standard, so we'll put this for our scenario today. And you can obviously increase it to 5 years if you want a little bit more of a discount on the cost. So 3 years is typical. We'll set that up right now for our estimate. Now let's compare what we saw a minute ago for conforming, where the discount points were very high, but now we see a higher rate, 8.5. It looks like this morning is one of the best options, but under 1 discount point. So even though it's a higher rate, these have no income verification, no employment verification, so much less paperwork, and we can lower the discount points and lower the closing costs therefore. So a lot of our investors are leaning towards this for a few different reasons, and we have hundreds of programs. These do vary widely, just like the other non-QM programs. You'll see here the DSCR varies, so please get with our team. They can navigate which one of these exactly will fit your scenario best. Another common request is for short-term rental properties. We get a lot of first-time and experienced investors both going for short-term rentals, where the DSCR for the long-term rent doesn't often fit, so we have to use short-term rents. So you'll see some of these options here might be a little higher rate, but they might allow us to use the short-term rental income. So please get with our team. They'll check out your deal, check out which scenario works best for you, and find the program that fits best for your deal. So those were all great options. Let me go ahead and introduce Jose's segment here. Let me pull up my graphic again so everybody can see. So thanks everybody for watching the live rates. Those are for our standard programs. Now we're going to do a deep dive with Jose, our sales manager here with 27 years of experience, into what is not necessarily a new idea, but this is a very popular, I would say, kind of trend and acronym that they've used for these programs, which is the BRRRR strategy. So a lot of investors in the, I would say, like the investment groups, right? Like the bigger pockets type groups, investment strategy, are using this BRRRR method. So that really means buy, and typically that means buy with hard money or cash. Renovate, right? Typically a fix and flip loan. Then rent, get it stabilized, obviously get long-term rents. Then refinance. Obviously, it's much easier to refinance if you have a renter in there. Jose will talk about options where you can still refinance just once the project's finished, obviously. And then once you refinance and you get your cash out, your equity out from the work that you put in, you can repeat. So this is a way for investors to quickly build a large portfolio by applying this strategy, accelerating it. So there's a lot of tips and strategies out there that are using this kind of acronym. But really what it means is someone that's going to, instead of fix and flip a property, fix and hold, right? So fix and hold it as a long-term investment, and therefore take out the long-term loan as a cash out so you can get some more cash to do it again, but also hold a long-term loan so you can hold that rental property. You don't have to actually sell it. So this is a great method. I love doing this method, done it myself a few times as well. But I'll let Jose go ahead and take over and explain a little bit more about the examples that he set up. So let me go ahead and highlight you, Jose, and you can take it over.
All right. Good morning, everybody. Welcome to Daily Mortgage Rates with the Mortgage Calculator. This is one that really brings a big smile to my face because this is usually the very satisfying culmination of a process where it starts with the fix flip, which I have up here. I have the quote that I prepared when we did our fix flip product, which was our property that our Ivan, the investor, let's call him, purchased for $400,000, right? Had $100,000 rehab budget, a $700,000 after repaired value, and we were able to get Mr. Investor a $440,000 loan. So right there, he's already like loving it. Paid $400, got $440, right? That's pretty good there. So now, where do we take this? So we have multiple scenarios here, right? The best case scenario for our investor is that he has the quickest crew in the West, and they're going to get in and out in 30 days. That property is going to be, in refinanceable condition within 30 days. And ideally then, our investor wants to tap into a program that is going to allow him to maximize the benefit of the transaction. And what would that be? That would be allowing our investor to obtain the full market value on his cash out refinance without any waiting time known as seasoning of title. On a conventional loan, which is a traditional route most people know of, in order to obtain the full market value versus the purchase price plus financing costs, which would be the minimal waiting time for a conventional loan. I mean, they're not even going to do it. First of all, they're going to make you wait 6 months to just be able to do the cash out. And at that time, they would just allow you for the value to be the purchase price plus whatever you put into the property would be what they would allow the market value to be. So our investor, obviously Ivan, he doesn't want that. He's like, Jose, I'm not going to get into this transaction and spend thousands of dollars in closing costs and not get an additional benefit. I know you can do it. And yes, we can, because at the Mortgage Calculator, we provide solutions, right? So our solution here is the zero seasoning option. Yeah, I get goosebumps. Yeah, April. Wow. In and out in 30 days. Absolutely. I'm telling you. So I'm going to share with you the first option here, DSCR cash out refi, 0-month seasoning. You heard me right. 0-month seasoning, right? In today, out tomorrow, as long as you are on title in the entity that's going to be taking title to the refi, as long as you're on title on the day that we initiate the application, no seasoning requirement. You just have to take title in the same name that you currently hold title, right, for the loan. So very good option again, because now you know that our property is worth $700,000. And what can we do here? Well, let me pull it down just a little bit more. And there you see loan amount $525,000. So now remember, he had a $440,000 loan. So he's cashing out what, $85K? So he's getting back his purchase price. And remember, he had $100,000 budget, right? And he had, I don't know, $18,000 maybe in closing costs. So Ivan here is getting back his full investment, the whole nut, purchase price, repairs, and closing costs in this new deal. And not only that, but great rates for a DSCR loan, which is, of course, probably the only thing that my investor would probably be able to do, because I'm sure he has like 20 properties, and it would be a nightmare. He's probably claiming a loss on each one. So DSCR is the best program here. Now you'll note 9.375, and I believe that should be about 3/4 of a point. And he can buy it all the way down to 8%. I think that's roughly like 3 1/8, 3 1/4, something like that around there. So very good buy down. We're getting in conventional loan rate territory there, but we are a DSCR. We are not full doc. We are not title in a personal name. We are DSCR, no income, LLC ownership. I mean, everything that our investor needs. The zero seasoning is really what they're looking for. Everything else is just icing on the cake. So again, zero seasoning option here, 9.375 with minimal cost, 3/4 of a point. So now our investor in our second example, his project took a little bit longer because, once he disassembled it, he realized it was a lot of damage. The termites had eaten away at a lot of the stuff, had to do a lot more work because, when you open those properties up, that's when you get those hidden surprises. So still amazing option here, because this one only requires 6 months seasoning to get the full market value. Again, 700,000 appraised value, 525 on the loan. He's getting back all his money. But look now that we have 6 months seasoning instead of 0-month seasoning, the rates are a little bit better, right? You have 8.75 at a nominal cost there of roughly half a point. And I'm going to switch over to the other one for a minute just so you can see that was 9.375 with a $3,800 point buy down. This one is 8.75 with a roughly $2,500 in fee for the buy down. But look at the rate. You can buy this down to 7.499. Now that is definitely in conventional loan territory, but again, we're not comparing apples to apples. The only similarity here that we have is that it is for an investment property. But after that, everything else changes, total deviation. We're in a total different ballpark here. So now, so that you can see what the conventional loan would be, but keep in mind here now, the conventional loan has limitations, right? You can't take title at the closing in an LLC, right? You can switch it over to the LLC. Let me switch over to the pricing here, so I'll explain to you. So 6.5, 6.625, not that many options in the conventional route. And these are really skirting the limits there of what they'll let us do. It's roughly I think it was a 2.875 points for the 6.5% rate, and about 2.875, I believe, for the 6.625 rate. Again, conventional loan, 12-month seasoning, not much of a benefit there, because if we switch over quickly, even looking at the best rate scenario here, similar cost, your payment is $33.18. Over here, your payment is $36.71. Not a whole lot to have to wait 6 more months for your money, or let's say 11 more months for your money if you were going with the zero seasoning option. Think about the opportunities, the opportunity cost of having to wait 11 months there, biting your fingernails, seeing deals go by, like you serious fear of missing out, because
that's the last R of the BRRRR, right? You got to repeat, right? So that's
yes,
where these investors love the zero seasoning, because they can repeat, which is the key part of the BRRRR strategy. If you can't repeat it quickly, it doesn't attain wealth quick, as quick as you want it to, right? So that's a great point, Jose. Thank you.
absolutely. So that guy's gonna, or girl, the investor is gonna be sitting there biting their nails, twiddling their thumbs, saying, when is the sand gonna finally pour out of that hourglass so that I can refinance my property? And who knows in 11 months where the rates may be, what the programs may be, what the opportunities may be, but we know what they are now, and we really want to be in a little bit more control of our destiny. So really not much of a benefit here to go conventional, unless it's like going to be their only thing. They're going to hold on to it forever and ever and ever, and they got some hang up about the rate and not the convenience. And also they're full doc. They don't mind taking title initially in their personal name, which could be an issue, because if you currently have title in an LLC, yeah, you're going to put it into your personal name. They will probably allow it as long as it's the same members that are on the LLC also then have to be the borrowers on that conventional loan for it not to be considered a name change, vesting, like ownership change, which would start the seasoning clock ticking all over again. So that a lot of restrictions, and then you got to take title in your personal name, and then you could put it into the LLC. Again, additional expense, and again, you have to maintain the integrity of the ownership. So the same owners, the borrowers that are owners in their personal name have to then be the same members of the LLC. You can't do any presto change over there and switch stuff, because if they find out, that's going to be an issue with your loan, and it could initiate the due on sale clause. So again, this here conventional example is for illustrative purposes only, because really the minimal the impediments, let's say, far outweigh the minimal benefits that you're getting with a slightly lower rate, even if you could qualify full dog, right? Which again, remember, most of our investors are DSCR for a reason, not because we are lazy as MLOs, but because that is the only option that they qualify for. So again, I'll show you these just so you can see this guy started with this property at 400. We got him 440,000, and then in the best case scenario, we put him right over here, lowered his rate, increased his cash flow, and put $85,000 into his pocket. Amazing opportunity.
Beautiful. Well, thank you, sir. We appreciate that. And let me go ahead and have Kyle just explain how to get with our team so you can get your own beautiful quotes like Jose was just showing us there. So go ahead, Kyle.
Yeah, thank you. I'm ready to go buy another property, right? It's exciting. So yeah, like Nick said, we like to take advantage of this too. So we have over 350 loan officers from all around the country. As Nick said in the beginning, we're licensed in 17 states. And then most of these BRRRR type projects, the DSCR loans and things like that, we can do in almost every state. So go ahead and reach out to us if you're already working with one of our loan officers. Maybe they referred this video to you. That's amazing. You can reach out to them and they can get you a quote within a few minutes, just like Jose was showing for their specific scenario. If you're not working with one of our loan officers, we can connect you with one. Just go to our website, themortgagecalculator.com. It's actually right here. And or you can email us info@themortgagecalculator.com. We would love to connect you with one of our loan officers. And as you can see by what Jose was showing, our loan officers are trained not just in the conventional and FHA, VA, USDA, but they're trained to be loan consultants with these other programs, these bank statement programs, the DSCR programs, the fix and flip, ground up construction. We have all these different programs, and we have loan officers who can consult you through the process on the best program for you in your particular situation. And they can quote you within minutes, just like those nice quotes that Jose was showing. So we appreciate everybody tuning in. I'm definitely excited to go burn more properties, right? This is definitely an amazing opportunity. Jose just got me even more excited. And we appreciate you tuning in, though. So we do this show 11 a.m. Eastern time every weekday. So definitely tune in to the next one. And each one we go through a different, highlight a different type of loan here, just like we did today with the BRRRR strategy.
Thanks for tuning in, everybody.
We'll thank you for tuning in. Appreciate it. Everybody take care. Have a great day. Let's go BRRRR some properties.
Thank you, everybody.